Hello and welcome to the session in which we would look at additional reconciliation to reconcile. Hello and welcome to the session. This is Professor Farhat. In this session we would look at additional adjustments to prepare the government-wide financial statement. So this is the picture of what we are doing. We're going from fund balances. We're going from the fund balances, okay, all the way to the government-wide financial statement. So what we are doing is we are trying to convert. So in the process of this conversion, which I explained this in the prior session, we already worked on long-term capital assets. So we already converted long-term assets. We already converted long-term debt. Now we're going to be working on conversion adjustments. In others, we're going to work on revenues, expenses, which is going to include interest expense, and the elimination of interfund transfer, that's easy to do anyhow. But those are the things we're going to be working about. Now, if you're not sure what we are doing exactly in the grand scheme of things, this is part 3 of a series of lecture of how to reconcile. So we already did capital adjust. This was session 1 or part 1. This was part 1. Then we work an example. This was part 2. The long-term debt. Then we work another example for part 2, and now we're going to be working in part 3. So this is part 3. So this is part 3 of 4 parts, because we're going to have the last part as the internal service. So let's go ahead and work on part 3. Well, a few things we're going to have to discuss and work on in part 3. One is revenues. So here are the steps. Deferred inflow of resources when it comes to property taxes. Remember when we talked about property taxes at the beginning of the semester? Property taxes deferred under the 60-day rule may not be recognized under the accrual, may need to be recognized under the accrual basis. So here's what happened. If you remember how we book our revenue, we say that we can accrue property taxes. That's what we talked about, okay? So we can accrue property taxes up till 60 days after year end. So any revenue we enjoy during the year and 60 days after. Now what happened to the revenues that we are going to enjoy after 60 days? After 60 days, remember, we call this deferred inflow. So hopefully you remember this. If not, go back and view the lectures about revenue recognition. We're going to work an example anyhow, but this is how it works. Remember, expenses are very similar between modified accrual and accrual basis. But there are certain expenses that are not recorded in government fund under the current economic resource model, like long-term portion of compensated absences. We don't record those. Also, we don't record, remember, pension. Pension is a long-term, we don't record it. Also, we don't record interest expense. We don't accrue interest expense. So such expenses we're going to have to record. So that's another thing we're going to have to do. And any interfund transfer, transfer between funds, transfer in for one company, transfer in for one fund, transfer out for the other. All these transfer in and transfer out will need to be also eliminated. So this is what we're going to be doing. So let's go ahead and start with revenues and look at how revenues work exactly, because revenues are, they had a prior entry, so they will need certain adjustments to be made. So let's look at imposed non-exchange revenues. What are imposed non-exchange revenues? Property taxes. Now, how do we account for property taxes? Well, what we do, we can accrue property taxes. So under the modified accrual, what's going to happen? Under the modified accrual, we debit receivable. So we are allowed to debit, for example, receivable 100, estimated uncollectible, let's assume 2, and revenue is 98. So this is what we did. So we can accrue property taxes. We learn about this in the revenue chapter. Now, so for this entry, there's no adjustment necessary, because guess what? We recorded the receivable and we recorded the revenues and the allowance. They all go on the government-wide financial statements. No adjustment is needed. Now, remember, deferral portion expected to be collected more than 60 days after year end. Remember, we talked about the 2-year periods. For example, this is year 1, and this is year 1, and this is year 2. Remember, 60 days after year 1, we could still count the revenue. What happened to revenue that we collect after 60 days that belongs to year 1, but we collected after 60 days? Well, what's going to happen under modified accrual, we reduce the revenue and we credit an account called deferred inflow property taxes, which is future revenue. Future revenue. So this is under the modified accrual. This is what we did. Sometime we might have debit an AR. Okay, but now what we're assuming here is we included all the revenue here, then we're taking it out. So what we do is we have a deferred inflow of property taxes. Now, when we want to convert to the full accrual, so this is full accrual, under the full accrual, guess what? Under the full accrual, that revenue, let's assume we deferred, this was, we said this is 100, this is 2, and this is 98. Let's assume of this 98, we deferred 8. Okay, that we're going to be collecting after 60 days. Guess what? Under the accrual, guess what? We are going to debit the 8 and credit revenue. So the 8 of revenue that we deferred here, it goes back and it's included in revenue. So this is one of the adjustments that we need to make. Okay, to include any revenue we deferred because we expect to collect 60 days later. Under accrual basis, there is no 60 days later. If you expect to receive the money, and this is an imposed non-exchange, you are entitled to it, therefore it's revenue. Okay, so this is how we adjust imposed non-exchange revenues. And the same concept is going to be applied to derived tax revenue, like income tax revenue, like income tax withholding are received. Well, as they are received, this is easy. The government will debit cash, credit revenue. So that's easy. There's no adjustment need to be made, no adjustment needed, because revenue is revenue. That's all what we need. Now, what's going to happen is additional income expected to be received after year end. Part of this will not be received in time to be available to settle current liabilities. The same exact concept. What we are saying is we can recognize all income tax withholding plus 60 days after. This is the 60 days after. What happened to the amount that we are expected to receive after the 60 days? The amount that we're expected to receive after the 60 days, we cannot recognize now. What we do is we credit deferred inflow. Now, just because after 60 days, accrual basis accounting doesn't recognize the 60 days. So if we are going to receive it, if we expect to receive it, we remove this deferred revenue, deferred inflow, we remove it and we recognize it as revenue. Therefore, any number we have here, let's assume we deferred 10 million. Now, under accrual basis, we need to recognize it. So notice revenue, so simply put revenue, is recognized. I'm sorry, what's going to happen? Any deferred revenue will be recognized into revenue. Okay, so any deferred revenue we book in this year, it needs to be reversed into revenue. Now, having said so, what's going to happen? Any deferred revenue we book the prior year will have to be reversed, and we're going to see this in a moment. So those are the adjusting entries that we will need to make. One is deferred inflow. It's going to have to be debited, and current year tax revenue will go up. Now, this is for the current year. Here's what you need to remember. Just like what we did when we did long-term assets and long-term liabilities, those entries are only worksheet entries. What does worksheet entry means? It means they don't make it to the general ledger. We don't book those entries. Worksheet, they are not reflected in the actual account. They are not posted. So what's going to happen? Any property revenue, so any entry we did the prior year, this is the prior year, will need to debit revenue and credit net position beginning of the year. This is to reverse previous year deferral. Simply put, here's what's going to happen. Let me just give you a quick example here. Let's assume this year we debited inflow of 10, credit property revenue of 10. Okay? Now this is this year. Now next year, let's assume now we're working with next year. Next year, we're going to have to debit property revenue of 10 and increase net position of 10. Why? Because this $10 that we recognize as revenue for last year, this $10 made it to the actual fund. Now, in next year, this $10 made it to the actual fund. So it's in the actual fund. Therefore, when you do, we need to reverse it. Therefore, we debit property revenue, credit net position. Then what we do again, for next year, current year, we will debit again deferred and credit revenue. And again, we'll see this as in an example clear. little bit better. But here's what you need to know. You will have most of the time, assuming you're not dealing with year one, 2 entries to make. One entry to recognize any deferred revenue, and another entry to reverse any deferred revenue you recognize in the prior year. Okay? So this is, let's assume this is year 3. So the current year is year 3. And this is also year 3 for year 2 to reverse year 2. So this is year 3 entry. This is year 3 entry to reverse year 2 entry. This is year 2 entry. So this is year 3 entry to reverse year 2. Also, we need to debit, not expenditure, we need to debit expenses and credit liability for compensated absences. Now, the same concept applies for expenses. Any expenses we book this year, we have to reverse. We have to reverse. Any expense we book this year, we have to reverse. We have to reverse the related expense the prior year, to be more specific. So notice here, for example, we debited interest expense, we credited interest payable to accrue the current year. At the same time, we have to debit net position beginning of the year and credit interest expense. This is for the prior year accrual, because the prior year, we recorded the expense. Then during the year, the expense took place in the fund. Then when we start the following year, we have to back it out of the financial statement. Then to close the transfer in and transfer out, it's easy. Debit, transfer in, credit, transfer out. So that's easy. And the best way to illustrate this is to actually work an example. I believe the toughest thing for a student to understand is, why do we do the reversing entry? So hopefully when we work the example, it will make more sense. The city of South Pittsburgh maintain its books so as to prepare fund financial statements and record worksheet adjustment in order to prepare government-wide. You are to prepare in general form worksheet adjustments for each of the following situation. So you have to read those carefully. Deferred inflow of resources. Property taxes of $47,500 at year end of the previous fiscal year were recognized as property tax revenue in the current year. And the current year statement of revenues, expenditure, and changes in fund balance. So what do we need to do? What are we told here? We are told that 47 at the end of the prior year. This was prior year. So last year what we did is this. So this is what I'm gonna have to show you this. So this is what we did last year. This is last year. Okay, it has nothing to do with this exercise. Last year, what we did is we debited deferred inflow of resources, $47,500, and we credited property taxes revenue, $47,500. This is what we did the prior year. Okay? This is what we did the prior year, last year. This is what we are told. Now, since the prior year has ended, this was the prior year, the third inflow that we counted as revenue to prepare the financial statement last year already made it to the fund financial statement. It's already recognized in the fund financial statement. Okay, why? Because at some point we assume that the third revenue is we received in cash, and we turn it into revenue as we received it. Now this year, we're going to be looking at the entries that we need to make this year. Now this is the entry that we make this year. We need to fix. Simply put, it's not fixed. We need to reverse out that revenue. We need to reverse the revenue from the prior year that we specifically this revenue here, the $47,500, that we recognized because it was not allowed under the modified accrual. Now what we need to do, we need to debit revenues, property tax revenue. We need to debit property taxes revenues, $47,500, basically reduce it. And what do I credit? No, I cannot credit the inflow. I'm going to credit net position. Net position, $47,500. Okay? Now this is this year entry. So let's go to the next entry and see it. Hopefully it will clarify what needs to be done. Hopefully it will shed some light. Transaction 2. Now listen to transaction 2 carefully. The city levied property taxes for the current fiscal year in the amount of 10 million. When making the entries, it estimated 2% of the taxes will be uncollectible, will be uncollectible at year end. At year end, 200,000, obviously 2% is 200,000 will be uncollectible. 349,000 would likely be collected in the first 60 days. That's fine. So far, so good. And now listen carefully and go from this. $51,000 would be collected after that time. So looking at this fiscal year, this is year 1, this is year 2. They expect to the estimated revenue, total revenue is 10 million. However, 51,000 of this 10, so the 10 million is for 2 years, but 50,000 of it, $51,000, will be collected 60 days after year 2. So what happened to that 60 days after year 2? That is the third revenue. So we cannot recognize it under the modified accrual. Okay, let me go back and use the numbers here. What we are saying is this: taxes, revenue is 10 million. Okay. Estimated uncollectible 200,000, okay, and receivable 9.8 million, 980,000. Now, of this revenue, of this 10 million, 51,000 will not be collected this year, okay, and 51,000 will not be collected within 60 days. So we debit revenue and we credit deferred revenue. So this is what they did under the accrual. This is what they did. Now, what do we have to do with this 51,000? We need to convert to accrual. Under accrual, this 50,000 will be considered revenue. Therefore, what we do for this year, we're gonna debit deferred revenue, deferred inflow of property taxes. And it was 51,000 that we deferred, and we credit revenue. We credit property tax revenue, 51,000. Now, this is this year, okay? This is what we need to do this year. Now, what do we need to do next year? So let's assume this is 2017. Okay, this is 2017. Now in 2018, the first thing we need to do when we start 2018, we need to reverse this entry. And this is when we debit deferred inflow. We need to reverse this entry. This is when we debit property tax revenue. We need to reverse it, property tax revenue, and we credit net position for this amount. So next year, 2018, when we start the year, we're gonna have to, let me do the entry. This is not asked in the question. So 2018, year 2018, what we do is we debit property tax revenue and we credit net position for 51,000. And now hopefully after I did this entry now makes sense. This entry makes sense. So this happened in 2016. This was in 2016. So when we started the year, we reversed it. So when we started 2017, we reversed it. This happened in 2017. When we start 2018, we reverse it. Okay? Okay. So, but our entry is as far as this example, those are the 2017 entries. Those are the entries that we are working with. But I just showed you what happened in the prior year to show you what happened at the beginning of the year and what happened this year and what would happen next year. Okay? So hopefully this makes sense, but let me take out the 2018. We don't need it. Let me take this one out. But this concept applies when we do a reversal, So hopefully it will help you with that concept of reversal. Let's go back to the example that we have on hand. Okay. Transaction 3. In addition to the expenditure recognized under the modified accrual, the city computed that $29,000 should be accrued for compensated absences and charged to public safety. So, what does that mean? It means we still have expenses that we need to record that were not recorded under the accrual basis, and we have $29,000 to record. Well, that's easy. We're going to debit an expense, credit a liability for that $29,000. So for that $29,000, we're going to debit public safety expense because they said charge it to public safety. We're going to debit public safety expense $29,000 and credit a liability compensated absence payable $29,000. Okay, so this is what we did. We recorded an expense that did not take place on the fund financial statement, but under the government-wide, it should be accrued. So that's pretty straightforward, this example. Now, the city actuary estimated that pension expense under the city public safety employee pension is $229,000 for the current year. The city, however, only provided $207,000 to the pension plan during the current year. So here's what happened. Remember when we did pension, we said we only expense under the modified accrual, we only expense the amount that we contributed. We only provided $207,000. Therefore, what we did is we debit pension expenditure. We debited pension expenditure $207,000 and credited cash $207,000. But the amount was $229,000. So for under accrual purposes, we need to recognize the full $229,000. So what we are missing is $22,000. Therefore, sorry, we're gonna debit. We're missing $22,000 in pension expense. So we're gonna also charge it to public safety expense, and that's gonna be $22,000, which is $229 minus $207 that was already recognized. Okay, so we need to debit expense $229 and credit pension obligation or pension liability or whatever you want to call it, but some sort of a pension liability of $22,000. Why did we do this? Because under modified accrual we only recognized $207 of the $229 obligation. Now, bear in mind, next year we might have to back out those expenses. We might have to back them out. We might have to do so. This way we don't double count them. Just like revenues, we might have to back out the expenses if they went through the fund financial statements. Let's look at the last example. In the statement of revenues, expenditure, and the changes in fund balance, general fund transfer out included $55,000 to the debt service fund. So we transferred out to the debt service fund that much, and $200,000 to a special revenue fund, and $900,000. I need to read this. We will read this. And $900,000 to an enterprise fund. Okay. So $500,000 to the debt service fund, $200,000 to the special service fund. That's fine and dandy. The $900,000 to the enterprise fund, that's really independent. So all we have to do, take care of basically the interfund, not between them and the enterprise. So the $700,000, we transferred out $700,000. Now what we do, we have to cancel this. We have to cancel the effect of this. Okay? So because they transferred $700,000 out, now we have to cancel it. Okay, so let's look at the entry when they transferred it out. When they transferred it out, they debit when the entry took place. took place. When the entry took place, here's what the general fund did. When the original entry took place, in total they credited cash. In total they credited cash. They credited cash 700,000, and they debited, transferred out 700,000. Okay, this is the general fund. This is the general fund. You know, let's break it into two components. Transferred out 500,000 to what fund? To debt service fund. The debt service fund. So let's do it in two steps. 500,000 and 500,000. That's to the debt service fund. Okay. Now, the debt service fund, what did the debt service fund do? They debited cash 500,000 and they credited, transferred in 500,000. Also, in addition to the debt service fund, we send 200,000 to the special revenue fund. So we go back here, and the general fund will again, they will debit, transfer out now to the special revenue fund. Special revenue fund, but the amount is 200,000, and the special revenue fund will debit cash 200,000, and they will credit transfer in. They will credit transfer in. This is what actually happened when those transactions took place. Okay. Now what do we have to do? Well, cash, it doesn't really matter. All the cash, it's going to be consolidated. So all the cash will be consolidated. So it doesn't matter. Cash goes down, then cash goes up. Cash goes down, then cash goes up. So over all financial statement, cash is the same. But all these transferred in, we have transfer out and transfer out. Then we have transfer in and transfer in. So all what we have to do now is do the opposite. Debit, transfer in. So here's the transfer in. So the transfer in, we have a credit of 700,000. We're going to debit, transfer in. We're going to debit this account, 700,000. Now the transfer in is gone. We eliminated the transfer in. And the transfer out, we have transfer out of, where's the transfer out? 500,000 and 200,000. It's a debit. What we do is we credit, transfer out 700,000. And by doing this entry, basically, we cancel the effect of everything. We cancel the effect of the transfer in and the transfer out between the fund. So this is how you do the transfer in and transfer out. Now it's going to be the same concept when we do to and do from. So this is basically a payable, and this is a receivable. This is a payable, and do from is a receivable. What we do is we cancel them the same way. We cancel them the same way. So we cancel them against each other. So this is basically how the inter-fund transfer is canceled. To summarize, once again, this is the entry to do the transfer in, the transfer out. We did not have any interest expense, but if we had to book any interest expense, debit interest expense, credit interest payable. Then if we have any interest expense from the prior year, we'll back it out. This is to book any expenses. This is wrong. Debit expense, credit any liability that we missed out. This is to book the revenue this year, and this is to reverse the revenue from the prior year that we booked. So hopefully those adjustments, this is part 3, so hopefully now you are getting better with these adjustments. The next topic will be the last adjustment topic, or the last conversion, is with the internal service fund. Now, how to bring the internal service fund to the government-wide financial statement. This will be part 4 and the last part in these adjustments. If you have any questions, any comments, by all means email me or see me in class. Study hard. Study hard.